Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down.
The Jackson Hole Symposium last week painted somewhat of a grim outlook for the economy by stressing that inflation is still too high and more rate hikes will likely be utilized if appropriate. But if we take a look at what's going on in the markets this week, Tesla is up around 11%, Nvidia is up around 5%, and the S&P is up around 3%. What's going on? What changed? Were there any surprises or catalysts that helped push stocks higher during a month that is typically the worst performing month of the year? First things first, let's talk about this massive investment by Tesla. According to Oppenheimer analyst Rick Schaefer, Tesla launched a colossal AI computing cluster worth $300 million on Tuesday. Now that's most likely not pocket change to us, but it's only about 1% of Tesla's current cash on hand. And when you think about it in this sense, a $300 million investment for a company as big as Tesla doesn't seem so significant. But what is significant is this AI cluster is built with a whopping 10,000 Nvidia H100 GPUs, making it more powerful than the world's third highest performing supercomputer. Elon Musk recently revealed that Tesla plans to spend over $2 billion on AI training in 2023 and another $2 billion in 2024, specifically on computing for fully self-driving training. Tesla is funneling over $1 billion to develop another supercomputer, Dojo, which is built on in-house designed, highly optimized chips. However, apparently Tesla wouldn't be developing their own chips if Nvidia could keep up with Tesla's chip demands. Dojo is expected to not only accelerate fully self-driving training, but it will also manage data processing for Tesla's entire fleet. Tesla plans to simultaneously bring its Nvidia H100 GPU cluster online along with Dojo. Not only could this computing power make Tesla more competitive than other automakers, but it will make the company the owner of one of the world's fastest supercomputers. Successful launches of these supercomputers also attract investors who see the potential for tremendous growth in both the electric vehicle and AI sectors. Tesla's supercomputer will undoubtedly contribute to advancements in AI research, which could potentially impact various industries beyond automotive. This news is great for both Tesla and Nvidia stock, but is this enough news to explain the huge jumps in the market like this? A lot of this information isn't necessarily new or surprising. Well, there was one surprise this week for retail traders. The latest job opening and labor turnover survey, or the JOLTS report released Tuesday, revealed the number of open jobs in the U.S. fell to its lowest level in more than 2 years last month. Economists surveyed by Bloomberg had actually expected a roughly 4% increase in job openings in July. The report also showed a decline in the quits rate, which is closely watched by economists because if an elevated number of people quit their jobs, that means those people are confident that they can get another higher paying job quickly. I mean, typically we change jobs to seek higher pay, right? If there's a high turnover rate, it could feed wage inflation. Additionally, the JOLTS report showed new hire numbers were the lowest since January 2021, and jobs created were the lowest since December 2020. The private payroll report by ADP also showed job creation in the United States slowed more than expected. ADP also reported that private payroll growth slowed for workers who changed jobs and those who stayed in their current positions. I think investors are looking at these preliminary labor reports as a sign the labor market is beginning to soften, at least enough to increase the probability of a rate hike pause. According to the CME Group, 88% of investors currently believe that the Fed won't raise rates in September. The Department of Labor's jobs report is due out Friday, which will give a clearer picture of how the labor market is really doing. However, based on fresh PCE data released on Thursday, overall inflation climbed to 3.3% from 3% previously, and definitely above the Fed's 2% inflation goal. Clearly, consumers are still opening their wallets for a range of wants and needs. When the demand for goods and services remain high, it could allow companies to keep charging higher prices. Additionally, unemployment is still near historic lows at 3.5%. Last week, Fed Chair Jerome Powell described the labor market's rebalancing as incomplete. Powell has repeatedly noted that getting inflation back down to the Fed's 2% goal will require some softening in labor market conditions. But I'd like to know what you guys think. Do you think we'll see a pause in rate hikes in September or not? That's all for today's video. Don't forget to like and subscribe if you enjoy this type of content. Thank you for watching, and remember to trade gingerly.